Welcome to the Deep Dive, your shortcut to being genuinely well-informed. Chasing financial freedom can often feel like running a marathon. Um, Uphill. Maybe in flip-flops, right? Some days you're pumped, ready to conquer. Other days, well, you're just wondering why you even bother saving. It's a feeling I think we all know well. So today, our deep dive is really custom-tailored for you. Whether you're gearing up for a big meeting, just catching up on the dynamic world of finance, or, simply have an insatiable curiosity. Our mission is pretty clear. We're going to unpack how to sustain that crucial motivation for your financial goals. And then we'll explore some powerful, yet often surprisingly overlooked, wealth-building strategies.
Yeah, that image of an uphill marathon, it perfectly captures the challenge, doesn't it? And the dedication required. So in this deep dive, we're focusing on two essential areas. First, we'll dive into practical, actionable insights, what some might call hacks, to keep that financial fire alive and burning bright. Second, we'll shift gears a bit to explore an intriguing strategy known as synthetic trading, alongside other surprising nuggets that can truly redefine how you approach building wealth. Our aim really is to provide you with those clear takeaways, the aha moments, and actionable perspectives without ever feeling overwhelmed.
Okay, let's unpack this then. Our sources are pretty clear. Motivation isn't constant. It just isn't. It naturally ebbs and flows, much like those challenging stretches in a marathon we mentioned. So what are the proven ways to keep that fire alive, even when the path gets tough and you maybe feel like quitting? Our sources highlight several key strategies, and the first one is, well, incredibly powerful: finding your why. And this means going beyond those kind of generic goals like, I want to be rich. We're talking about digging much deeper. Is your why maybe the freedom to ditch a soul-crushing 9 to 5? Is it giving your kids opportunities you never had? Or perhaps having the financial independence to care for family without that constant strain? The actionable tip here is actually quite simple. Write it down. Make it visible. Put it somewhere you'll see it every day. That deeply personal why becomes your North Star when life inevitably throws curveballs.
What's fascinating here is how these practical steps acknowledge that financial freedom isn't some straight, easy path, and your motivation will absolutely fluctuate. It just will. They empower you with the mindset, and crucially, the systems needed to keep moving forward even through those dips. And building on that why, once you have that anchor, it's so important to acknowledge progress along the way, because big financial goals, they can feel scary and, frankly, distant. So celebrating those small wins is absolutely key.
It's so true, yeah. Seeing that progress really does shift your mindset, doesn't it?
Yeah.
Our sources suggest these wins could be things like paying off a significant chunk of debt, maybe hitting a savings milestone, or even just consistently sticking to your budget for a full month. That takes effort. And the benefit, well, a small, well-deserved reward fuels your brain, it prevents burnout, and it keeps you motivated to tackle the next step.
Absolutely. And, as you mentioned, you don't have to go it alone, which leads us right into another crucial point: building your tribe. Surround yourself with people who understand, people who are also on this journey, whether it's friends, maybe online communities, or a partner with similar goals. The value here is just immense. You can share wins, struggles, and, importantly, genuine laughs. That accountability and encouragement makes the road feel far less lonely and, honestly, significantly more achievable.
Right. And while it's so tempting to get bogged down in the minutiae of spreadsheets,
Yeah.
another strategy our sources strongly suggest is to focus on freedom, not just the numbers. It's about shifting your perspective, really. Instead of obsessing over every single digit, picture the life you truly want. Waking up without an alarm, maybe, taking that dream trip, or simply having the space to breathe and pursue your passions. Let your goals be about that envisioned freedom, not just the zeros in your account. That mental shift can be an incredibly powerful motivator for the long haul.
And a particularly insightful point from our sources, I thought, was to cultivate what they call a screw it fund. Because life happens, right? And sometimes you just need to treat yourself without feeling guilty about it. The idea is to proactively set aside a small chunk, maybe like 5% of your budget, specifically for guilt-free fun. This prevents you from feeling deprived, which, let's face it, is a major driver of burnout on any long journey, especially a financial one. It's about finding that balance, rather than just enduring constant deprivation.
Huh. That sounds almost counterintuitive to saving, but it's brilliant psychology, isn't it? It keeps you in the game. And okay, for ultimate consistency, the deepest hack seems to be automate and systematize everything. Set up automatic savings, automatic investments. The goal is to make the hard stuff, the consistent stuff, completely automatic so it continues, even on your lazy days or your most stressful days. Think about it. Meal prepping maybe? Unsubscribing from those tempting shopping apps? building entire systems that support your goals even when your motivation inevitably dips. These aren't just one-off actions. They're structural changes that make progress almost, well, inevitable. And that consistent automated progress connects beautifully back to the idea that the journey isn't perfect. There will be mistakes, absolutely, but every small win, every automated step makes it worth sticking with.
Indeed. Yeah, it all ties back to having a robust framework in place, which naturally leads us to consider, okay, once you have that motivation and those systems humming along,
Hmm.
what are some of the smarter tools available to truly accelerate your wealth building journey?
Okay, now, let's pivot to a strategy our sources delve into that truly aims to make your money work smarter, not harder. Synthetic trading. Now, it sounds incredibly complex, I know, like something only Wall Street pros touch, maybe, but it's actually a remarkably clever and surprisingly accessible approach once you understand the core mechanics.
Yeah, and zooming out for just a moment, smart trading isn't really about being some kind of genius. It's more about having the right tools, the right strategy, and often the right insights guiding you. Synthetics are a prime example of such a tool. They represent a powerful sort of leveling up in an investor's or trader's arsenal.
So, what exactly is a synthetic position? Let's break it down. In simple terms, it allows you to mimic the ownership of an asset, like a stock, without actually buying the underlying shares directly. It's a kind of combo move. You effectively buy a call option, which gives you the right to buy a stock at a specific price, the strike price. And simultaneously, you sell a put option, which gives someone else the right to sell that same stock to you, also at that same strike price. And crucially, both of these options would have the same future expiry date. You do that, and bam, you've essentially created a synthetic stock. To give you an analogy, maybe think of it like renting a house, but you're still able to collect rent from tenants. You don't own the property outright, right? But you get most of the financial perks and benefits of ownership without having to pay the full purchase price. It's an incredibly capital-efficient way to gain exposure.
And traders really gravitate towards synthetics for several key reasons. Firstly, as you said, you typically need significantly less capital upfront compared to buying the actual shares. That's a big one. Secondly, they offer a tremendous amount of flexibility. You can tweak your setup as market conditions evolve, allowing you to tailor your exposure to different environments, different outlooks. This combination of flexibility and capital efficiency makes them very appealing for certain sophisticated strategies.
Okay, let's look at a concrete example from our sources that really brings this to life. The IB synthetic strategy. And for those unfamiliar, IBIT is a Bitcoin ETF. Essentially, it's Bitcoin wrapped up in a stock format. It's a way to gain exposure to Bitcoin on the traditional stock market without, the complexities of direct crypto ownership, like setting up wallets or managing private keys. Much simpler access. So the setup here involves taking a long call and a short put on IBIT. Both are at a $45 strike price, and they expire quite far out in 2026 in this example. Now, this combination effectively acts just like holding 100 shares of IBIT, but without you having to come up with the full, $4,500 that 100 shares would cost at that price point. What's even more interesting is that the premium you receive from selling that put option can often help pay for most of the call option you bought, so it significantly reduces your net cost up front. Pretty neat.
Right. And with this synthetic stock position in place, the trader then moves on to the next step, selling weekly calls against it. For instance, they might sell a call at, say, a $68 strike, expiring on a much closer date, maybe June 13, 2025. This is where the ongoing income generation part of the strategy comes into play. Okay, so what are the potential outcomes with this strategy? Let's walk through them. If IBIT stays below that $68 strike by that weekly expire date, well, you simply keep the premium you collected from selling that call. Our source playfully describes this as a free money snack. I like that. However, if IBIT climbs above $68, your synthetic position gets called away. Now, your upside is capped at $68, but remember, your synthetic was established effectively at a $45 strike, so you're still sitting comfortably in the profit zone. Quite comfortably. You just won't capture any gains beyond that $68 level, which is often considered a fair trade-off for the steady income you've been pocketing along the way. Traders often call this particular setup a synthetic covered call, or maybe a covered call on synthetic stock, or even just a buy right synthetic edition. Lots of names for it.
Okay, so what does this all mean for you, the learner? Maybe considering this as a potential strategy. Let's break down the practical pros and cons. On the plus side, you get that consistent, steady income from selling calls. That's really attractive, especially in sideways or just gently bullish markets. Plus, it requires significantly less upfront cash than buying the shares directly, which, can free up your capital for other opportunities. The promise of steady income with less upfront cash is certainly a powerful draw here. But of course, every powerful tool has its considerations, its risks. The cons include that it definitely caps your upside if the stock truly rockets. You won't participate in those massive parabolic rallies. So forget moonshots. Your synthetic long position can also suffer if market volatility drops hard. That's a factor. Also, the margin required for the short put leg of the strategy can be quite chunky, depending on your broker and the underlying asset. And fundamentally, you are essentially stacking leverage here, which means your risk management truly becomes non-negotiable. You have to be disciplined. The bottom line seems to be. It's a fantastic strategy if you expect moderate bullishness without crazy rallies. But it's probably not the ideal play if you're chasing those moonshots, those huge gains.
Exactly. And this strategy really highlights a crucial point for any sophisticated investment. Understanding the risks and rewards is absolutely vital. You can't skip that step. The source for this strategy emphasized that it was developed through quant research, which means using rigorous data, mathematical models, and backtesting to drive trading decisions, rather than just guessing or relying on market sentiment and, hype. This structured, evidence-based approach is really key for building confidence and managing risk effectively when you're using such sophisticated tools. And as you mentioned earlier, host, IBIT is indeed a Bitcoin ETF, a very accessible way for many people to gain exposure to Bitcoin on the stock market without diving into the sometimes daunting complexities of direct crypto ownership. It makes it a viable option for a wider range of investors.
Right. So moving beyond specific trading strategies now, our sources also reveal other fascinating nuggets about the broader landscape of wealth building. Everything from cautionary tales that can save you a fortune to incredible opportunities born from, well, foresight. Let's start with a cautionary one, The China Hustle. This documentary apparently provides a really gripping insight into massive financial fraud, specifically in Chinese companies that were listed on U.S. exchanges. The big idea here is a stark and frankly important reminder. Markets, even global ones, can be manipulated, sometimes at an epic scale. Uncovering these frauds can literally save you from incredibly costly mistakes. It matters profoundly because it really urges all investors, you, me, everyone, to conduct deep, independent due diligence and to seriously question seemingly too good to be true investments, especially when dealing with emerging markets or complex international structures. The actionable step is crystal clear. Always check for transparent financial reporting and independent audits before committing your capital to foreign companies. It sounds almost like a real-life financial thriller, doesn't it?
It really does. That's a crucial cautionary tale for our times, absolutely. But on a completely different and far more optimistic note, we also uncovered the incredible story of the $20 domain that became a multi-million-dollar jackpot. So, back in 1994, way back, a forward-thinking individual named Chris Clark registered pizza.com for a mere $20. Apparently, he initially envisioned it for his consulting firm. But this incredibly modest, almost whimsical investment, bought with serious foresight, turned into a multi-million-dollar sale years later. Amazing. It vividly highlights the often underestimated potential value of early internet domain acquisitions and really the sheer power of long-term vision. It's an incredible story. And beyond these deeper dives into specific stories and strategies, our sources also spotlighted a few other fascinating areas of wealth building. Just to give you a taste of the diverse paths available out there. For instance, in cash versus card, which saves you more. Quote, the surprising insight wasn't just about, tracking expenses, but how the physical act of spending actual cash can psychologically curb impulse purchases more effectively than the often invisible digital transactions. Swipe and forget. It really makes you think about your day-to-day spending habits, doesn't it?
It absolutely does. And connecting back to our earlier discussion on synthetics, another resource we explored was Understanding Synthetic Options, a beginner's guide. This piece really reinforced that while options can appear daunting at first glance, breaking them down into their fundamental components reveals their elegant versatility for both hedging risk and potentially generating income. It makes them less of a mystery and more of a powerful financial tool in the right hands. And for those considering different asset classes, maybe real estate, residential versus commercial properties, which is the better investment? Offered some great perspective. The key takeaway seemed to be that the better investment often comes down to your individual factors. Your time horizon, your risk tolerance, how much hands-on involvement you want, with commercial properties potentially offering higher yields, but also generally greater management complexity and higher capital requirements. No easy answer there.
True. And finally, we looked at $14K passive income, a self-made millionaire's side hustle secrets. Here, the profound insight wasn't about some single grand venture, some get-rich-quick scheme, not at all. It was about how compounding small, consistent efforts from diverse, often digital income streams, Things like content creation, affiliate marketing, or maybe niche online businesses, how that can build substantial, truly passive wealth over time. Slow and steady wins the race, sometimes. So if we connect all these diverse insights to the bigger picture, what really emerges is that wealth building isn't just one linear path. It's not a single strategy. It really requires a blend of diligence, definitely curiosity, and an openness to different approaches. Everything from avoiding fraud and seizing unique opportunities to optimizing daily spending and deploying sophisticated trading strategies like synthetics. Crucially, it's about combining that consistent motivation we talked about right at the start, combining that with smart, informed choices and a keen understanding of the ever-evolving financial landscape around you. You've got to stay informed.
And there you have it, a pretty comprehensive deep dive today. We've explored practical hacks to keep your motivation ignited on your financial journey. From finding your deeply personal why and celebrating those small, important wins, to building your supportive tribe and automating your entire financial system. We then demystified synthetic trading as a potentially smart tool for generating income, understanding its intricate setup, its appealing pros, and importantly, its significant cons. And we touched on broader insights, from that cautionary tale of market fraud and the China hustle to the unexpected windfall of an early internet domain, and practical tips for everyday spending and building diverse income streams.
Yeah, and as you carry these insights forward, maybe consider not just the tools and strategies we've discussed, but how your personal why for financial freedom can powerfully guide your choice of strategy. Does it align? And remember how cultivating your tribe, that community of supportive individuals, can make even the most complex financial journeys feel less lonely and far more successful. The journey itself, it won't be perfect. There will definitely be ups and downs. But every small win, every informed decision makes it truly worth sticking with in the long run.
Thank you so much for joining us on this deep dive. We really hope you found some fresh perspectives and maybe some actionable ideas to implement in your own financial life. Here's something to think about. What's one thing you've tried lately that maybe surprised you on your own wealth journey? We'll see you next time.